Welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Hall Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not, however, investment advice, so please check the disclaimer in the show notes. In this episode, I'm talking about keeping it simple in the investment office.
This is the Family Office Sherpa.
So I've had a number of conversations recently with family offices and I guess to a certain degree have had them for quite some time. And the theme is continually coming up, which is the desire to reduce complexity in how the assets are managed or how the investments office is run, really. So like with all things, over time, a lot of portfolios have accumulated managers, strategies, structures, underlying constituents, often with really sensible reasons at the time. But what it results in a lot of time is a portfolio that is hard to understand, harder to oversee, harder to implement, and to a degree, most importantly, harder to get people engaged with and to explain to other family members in the next generation. So what I'm hearing more often now is families are stepping back from the portfolio and asking whether the investment structure itself can be simplified. And to be honest, a lot of the time that's where I come in. We're looking for things like fewer counterparties, clearer mandates, more straightforward portfolio exposures, and really interestingly, decision-making processes that are easier to govern, really. So in this episode, I thought I'd go through a few observations from working with different family offices over the years. I'm going to give some practical areas where simplifying the way investments are structured. You know, from my experience of working with family offices, I'm not sort of just making it up myself here. These are reflective of what I've actually seen and how they've managed to make their portfolio easy to run and oversee. Okay, so let's get started. First one, we're looking for a smaller number of counterparties. Often you hear that we're seeking diversification in their wealth manager or advisors. And look, I understand the intention. Don't have it all with one counterparty, create diversification. Some people talk about competitive tension, those sorts of things. But what we end up seeing, if this is not done well, is a portfolio or several portfolios that look really, really similar and a total portfolio that looks like over diversification and then really increases our underlying holdings with no real benefit, right? You get redundancy in positions, you get some fund managers and advisors going this way, the other going this way. And what ends up happening is you end up with what looks like a really big, passive, multi-asset class portfolio. The best I have seen are those that look for managers that have very different use cases. So what have I seen people do? They're really explicit about what risk you're actually diversifying. You're diversifying operational risk, investment style risk or something like that, or counterparty risk. Don't confuse them. So understand why you have more than one counterparty in terms of the advice and portfolio management outsource, and then really dig down into to see if it really does create diversification or it's just the illusion of diversification. And really importantly, periodically look through the portfolio across managers to understand overlap in holdings, exposures and strategies. One of the things that we used to be tasked with at State Street in the investment solutions group, and look, we're getting, a lot of wealth managers, specifically sort of global private banks, offering this as a potential service, which is give us the portfolio and we'll do an overlay or we'll do some version of analytics to see where exposures are, from factor base, are you overweight to value or growth or what your underlying liquidity looks like, all these sorts of things. So I think this is starting to see this a little bit more in particular, that sort of outsourced chief investment office piece or the private bank piece and just wealth management generally, just being really helpful around sort of how, can you give us an independent, diagnostic? Anyway, next one, be concise in your investment policy statement. We are not institutional asset owners here or a firm, with a broad range of clients. We are a family office, often with a really small number of decision makers and beneficiaries. So therefore, the investment policy should represent our intent, not that of our counterparty, right? So the IPS should clearly state what the decisions pertain with the family and what is delegated managers or advisors. And that's where I've seen confusion and complexity happen. Whose job is this? Who's making this decision? Who has oversight here? Make it really explicit in the investment policy who does what. The other thing I've seen work is to keep it usable. If nobody reads it before making the decisions, it's too long or too vague. So this is what we bring back in every investment committee meeting that I'm on, right? How is this decision being made? And if we're not following it, then there's a problem with the investment policy. Either we're not engaged with it. A lot of the time, I love bringing, the investment philosophy component of the investment policy piece, because what that does is, like, everything we do is on the board. There's this North Star sort of sitting there going, are we following the intent here? Next one, maintain straightforward data. The smallest amount of logins to platforms, the smallest number of platforms, smallest number of transaction accounts, smallest number of investment entities, counterparties like banks and things like that. I'm not saying keep it all in one place. What I'm saying here is, again, kind of like the over-diversification on the investment constituent side, is that if we can have it all in, and we're starting to see this now, which is to keep it all in one platform or one login, and what that does reduce is the amount of logins that are around and potentially people getting into access other platforms. So I really like the idea of centralizing that data. So, data should have one clear source of truth. So, all the reporting discussions are about decisions. I've said it in the past, which is good reporting, good investment reporting creates, usable advice or creates advice, not reconciling numbers all the time, not just going, well, I'm not. And if you don't trust it, that's a whole other thing, but that's really a major problem. So keep it straightforward. If you can reduce the number of data points, it's really, really helpful. Also, you can reduce operational risk by automation of that data flow where possible, rather than relying on manual spreadsheets. And that's pretty obvious, but I think I wanted to reiterate that, because to keep things simple means that if you don't have to double handle data, don't have to, private markets in particular, because you have to go through that other portal a lot of the time. If you can automate that, if you can, and there's plenty of software that, we're starting to see that really improve. So just really concentrate on that. So the less we deal with moving data parts here, the more impactful the reporting can be. Next, you want heavily curated and reviewed scaffolding, right? So the support networks, transient or permanent. If, maybe what I've seen is that a lot of clients are going, hang on, we can get our counterparty A to do this, 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 and this. And they're very, very good at it. And they've got, good compliance within it and all that sort of stuff, and things that we wouldn't be able to do. So why not give them more of our wallet? I think that's a question that sometimes a tough conversation too, right? Like, are we going to get rid of this long-standing relationship with this counterparty and give it to this one just because they do a better job? Yes. Unfortunately, that's what we do. So fewer counterparties or fewer providers also do this great thing, which make accountability clearer. There's the idea that there's one neck to choke or something like that, which sounds horrible. But, what it means is that there's one counterparty where, if I want any question answered, I got one number to call. I call that number and I'm going to get either an answer, or I'm going to get someone on the other end of that phone call or that line that says, I will take care of this. And that is an amazing thing to have happen, as opposed to, I'm going to call Bank A. They're going to go, well, this is not our platform. This is someone else's. We only look after this. And you go, oh, okay, this is going to take me, this is going to be hours. Whereas, this is why this whole element of concierge, I think, still is maintained, which is, we will take care of it for you. I mean, it's an amazing thing. The other thing to keep in mind, though, is to periodically review that scaffolding, really to make sure ensure that it still matches the complexity of the portfolio. And that can be both ways, right? If you decide, you know what, I'm just going to create an investment portfolio that is 6 ETFs or something or 6 index funds or whatever it ends up being, and that's all we're going to do. We can reduce the significant amount of counterparties there. You've got to live with the fact that that you are simplifying it, but you know what I mean? Like if your complexity and scale goes up or down, you need to review it. Right, next one. Make implementation easy to execute, track, and manage. Now, this isn't a question of active versus indexing or anything like that. It's more, we have our strategic asset allocation. What are we giving up? Usually potentially higher returns and idiosyncratic sort of risk for simple, easy to understand and explain market exposure. So it's that payoff, right? So, and I'm not saying this to be controversial. All I'm saying is if you give up the simplicity of this version of implementation for this reason, then make sure that reason still holds, right? And all investment decisions are active ones. There's no such thing as passive investments, right? This is a question of what are we trying to achieve here and where are the markets that support sort of the more complex idiosyncratic structures and potentially those that historically benefit from simple execution that we can almost either completely outsource or we've got one line in our reporting. Just think about it from that perspective. So what I've found with family offices is that some are preferring structures where, the portfolio exposure can be clearly explained when it goes up or down to one or two sentences sometimes. And consider and this is really a big part of it as well. So consider the ongoing operational burden of these complex investments too, not just the expected return. And I think, if you're a front office kind of person, which is like, I've done the trade, I've done the investment, think about the cascading effect of that investment as well. Okay, we're going to have a lot more administrative burden. We're going to have a reporting that takes into consideration potential lags in investment of getting a net asset value or something like that. So just think about it from that point of view. So all the costs have to be embedded, not just fees, but time, complexity, counterparty, all that sort of stuff, and go, yes, it makes sense. Okay, that's all I'm asking. Next one, be thoughtful around staffing. By all means, keep it lean, right? If that's the preferred model, but be able to, let go and outsource the heavy lifting if you're going to do it. And that's just something that I've found works really well, which is to say, we're going to do this, but we're going to outsource this, this, and this, and let it go. Outsource a lot of the heavy lifting and really let it go and get specialist firms to do it for you. Or if you choose not to do that, resource internally and give time for people to do things well. Resource it, give them time. This is your job, not this is your job at the last hour of the day and you're doing your actual job and we're going to give this to you as well. So, but importantly, avoid building teams that are too small or too lean to maintain resilience. Once someone leaves or is unavailable or sick or something like that, and really think about that, which is that, we want to keep it lean. So what's the redundancy here? Like what happens if something happens to this person? And that's the benefit sometimes of outsourcing, which is to say, well, they've got thousands of people that do this, or I've got a team that works over there for the office. If one person's sick, that's fine. There's 2 or 3 people that can actually, that redundancy piece. So just be mindful of that. And, ensure staff are spending time on decision support and oversight and helping the office, not administration, because that can sometimes be, a challenge for staff retention. Next one. Always have an investment committee that knows its job. That means we are an investment governance function or structure. We are not management. The committee's role is to set direction, approve strategy, and challenge things like, challenge assumptions, right? We're not there to pick the individual assets and underlying constituents and things like that. We'll be a part of the RFP and things like that to find managers to do that for the office, but we're not portfolio management. Investment committee meetings should be focused on forward-looking risks and decisions not just this continuous past performance review, right? Because, and this is the thing too that I found, if you've got a quarterly meeting, what ends up happening is if you have a quarterly meeting in January, February, March, and you have one in March, no one's talking about January. Everyone's talking about March and Feb, maybe. But you know what I mean? This is why you have to be cognizant of the portfolio. You need good reporting so we know what we've got. So we come into these meetings really knowing, pre-read here. We've pre-read. We know what's happened. What we're concerned about is, are we managing the risk associated with the portfolio, and do we know where we're going? That's it. And next one is make decision-making process clear and follow it. Document who decides who advises and who implements each of the decisions. The amount of time that we get bogged down into, well, this is them. This is their decision. No, this is us. We're doing this. Be really, really clear, and do that in the investment policy. I always do it, which is say, this is the decision-making process. So make it really, really clear who makes decisions and what, and really be consistent in the process, because what that does is it helps families stay disciplined, especially during times of market stress. And that is where you've seen the simple, sophisticated model work really well. Market stress. And last one. So give agency to those that need it. And when I say that, I say some offices can be structured so tightly around a principal or a single senior staff member that what you find happening is that everyone else waits or has to wait passively to be asked the right questions rather than being able to be proactive and flagging issues. If nobody's looking for problems accumulate quietly. And the reason why I put this in keeping it simple is because in my mind, that's a really simple way of getting the portfolio to be run in a way that we're not going to find these bombs later, right? And that's what complexity causes a lot of the time. This, like I said, these problems accumulating quietly. So if you've got people that are proactive and also a simple office is easy to be proactive in because, like I said previously, they know what the decisions are. They know what the investment committee is. They've got the reporting. They've got all these sorts of things that we just went through. And so they can be proactive, but you've got to give them agency. You've got to give them the ability to speak up for that. So I've seen it work well when they encourage a culture where raising concern early is seen as a positive and not as someone attacking their investment decision and not a criticism. And I've seen, and the other thing is, ensure key staff and your advisors, we talked about that. If we've got good counterparties, you got to give the advisors clear authority to escalate issues without us having to wait for permission. Because people go on holiday, people are unavailable, all these sorts of things. So I think I'll leave on that one. So in conclusion, the lesson I keep coming back to is that the most effective family offices don't build complexity, they build clarity. And you can be sophisticated and have a simple structure. They simplify things like their partners, their reporting, governance, and their portfolio so the structure works quietly in the background. When the scaffolding is simple and well designed, the family can focus on the important decisions. That's what we really want, right? We want good advice to be brought up. We want people to be able to make decisions. We want people to make better decisions because it's simpler, right? If you're interested in understanding how I work with clients on these kinds of things, like getting to simplification. Often I am brought in when there's too many moving parts, it's unwieldy, we don't understand what's happening. That's when I come in a lot of the time. Please feel free to email me, Shaun, SHAUN @wholroad.com.au, or you can ping me on LinkedIn. If you like this content, you can subscribe to the Sherpa newsletter. It's been going for over 7 years now, and you can find that at wholroad.com.au. If you're enjoying the podcast, please ding the alert bell so you'll get the next one and you'll receive a notification. Please visit the Sherpa website, www.thefamilyofficesherpa.com, when you can see the podcast, newsletter, guides, and videos. Till next time, thanks for listening.